This is Ralph Sass, and this is the lecture for Chapter 9 for Financial Accounting on Plant and Intangible Assets. And once again, this will probably be broken up into two parts, each one about 15, maybe 20 minutes. Um, when we put plants and assets on the balance sheets that are going to provide a stream of future services, it's unfair for us to count them as an expense in the year we purchase them. So what we're going to do is we're going to put them on our balance sheet as an asset. And then what we're going to do is as we use them up, we're going to depreciate them. Okay, so what we're going to do is we're going to put our truck, rather than the 40 grand that we paid for the truck and count it as an expense when we wrote the check for 40 grand, assuming we paid cash, we're going to say, you know what, we're going to put that truck on our balance sheet at 40 grand because it's an asset and it's going to provide us services for the next 5, 6, 7, maybe 10 years. And then we will depreciate it over its useful life. There are three major categories, and in this video, I'm pretty much going to limit myself to talking about tangible plant assets. Okay, things like land, buildings, equipment, cars, what have you. In the second part of the video, we will talk about intangible assets. Intangible assets have no physical substance, so you can't see, touch, or feel them. Things like patents, copyrights, trademarks, goodwill, if you bought a franchise. And so those will all be talked about in the second part of the video. And natural resources will also be talked about in the second part of the video. We spend very little time on natural resources, to be quite honest, but things like if I bought land and was going to extract oil from it, or perhaps I was gonna cut down the timber, things like that would be included under natural resources, and we would deplete that, but we'll talk about that in the second video. For all long-lived assets, there are three accounting events that we need to worry about. The first one is when we acquire the asset or when we buy the asset, we need to put it on our balance sheet. That's item one. Item two, then, over the period of its useful life, we need to depreciate it, and that's going to be the depreciation. And that's going to happen over 2, 3, 4, 5, 10, 30 years, whatever that time period is going to be. And then theoretically, at some point, we're going to dispose of that asset. We're going to sell that asset. And that becomes the third part where we need to take into account, from an accounting perspective, its, its useful life. We need to record something from an accounting perspective. When we buy an asset, the cost of that asset, what's going to go on our balance sheet, is not just the asset price, but also any reasonable and necessary costs for getting it into the desired location and getting it ready for use. So we're going to have not only what we paid for it, not only the sales tax and what have you, but we're going to, and in fact, I want to skip back here, but also everything to get it ready for use. So if there's a shipping charge involved, that gets included as part of the cost of the asset. Suppose I need an electrician to come into my building to wire it. That gets included in part of the cost of the asset. Perhaps I need to spend 2 weeks running it to tweak it so that I get it to produce exactly what I want it to produce. That's all part of the cost of the asset. So the cost of the asset is everything necessary to get it into spot, ready to use, ready to go. There are some special considerations. Things like land is going to include the cost of the real estate, and as well as like commissions, legal fees, clearing and grading the property, what have you. And one interesting thing is that suppose I bought a piece of land that included a building, and the first thing I did is plowed down the building because it was an old decrepit building and I'm not going to use that building. That entire cost then, even which theoretically includes part of the cost of the building, is going to be part of the land. I need to keep track of everything separately. So the land is separate because the land I cannot depreciate. Theoretically, the land is always going to be there, so the land is non-depreciable. So I'm going to have to keep that separate from things like land improvements, things like driveways, fences, landscaping, because those are depreciable. So I'm gonna if I bought a building, let's suppose I spent $1 million for the building, I'm gonna need and the land in the parking lot and the shrubbery, what have you. I'm going to have to have somebody come in and say the land is worth 300 grand, the building is worth 600 grand, and the parking lot and what have you are worth 100 grand, so that I can depreciate them all separately. Buildings include the cost to remodel prior to the building being put into use. So suppose I bought the building, but I needed to modify it in some way. I had to have a carpenter come in and build some walls, build some offices, whatever. That's all going to get included in the cost of the building. Okay. And finally, equipment includes the interest, the insurance, property taxes, are all going to be treated as expenses right away. So interest, insurance. So I'm going to include the cost of the equipment. I'm going to include all the costs to get it ready for use. But things like insurance and property taxes are going to be expenses in that current period and are not going to be depreciable. So when we, and I already mentioned this, when we buy an asset, when we buy, and really it applies to buildings, when we purchase a building, keep in mind it includes the land, it includes the parking lot, what have you. We're going to have to allocate that to separate accounts based upon the fair market value of each asset. A lot of times, and there are financial experts that'll come in and tell you exactly what each piece of that is worth. You need those types of statements so that you can appropriately put them on your balance sheet and so you can appropriately depreciate them. So you do need to break out, it's not just, hey, I bought the piece of property for $1 million. You're going to have to break it out. How much of that million was for the land? How much was for the building? How much was for the parking lot, etc. There are two things that are really important to realize, and that is there is a difference between capital expenditures and revenue expenditures. A capital expenditure is any expenditure that's going to benefit several accounting periods, and for that we're going to put it on our balance sheet and we're going to depreciate it. For other expenditures, they're called revenue expenditures. They're ordinary repairs and maintenance, and we're going to charge that immediately to an expense account. Let's take a truck for example. If I have a truck and I go to get the oil changed, that's a revenue expenditure. It's an ordinary repair and maintenance. I'm going to write that off. If I go get new tires on it, it's probably going to be considered a revenue expenditure. I'm not going to depreciate it, and I'm just going to write that off. If, however, the truck needs a new engine and I put a new engine in it, now that's 2, 3, 4 grand, whatever that number is. That is probably a capital expense that I'm going to depreciate over its useful life. One key note here is it's got to be material. Notice under capital expenditure it says any material expenditure. So the question also comes up, is it material? What's material for one company may not be material for another company. So what is depreciation? Depreciation is the allocation of the cost of an asset over its useful life to an expense. It's a way to turn an asset into a depreciation expense. So just like in the last chapter where we're putting inventory on our balance sheet, and then as we sell it, it's turning into an expense on cost of goods sold. Kind of the same things happen in here. I'm putting a long-lived asset on my balance sheet, a truck, a building, a piece of equipment, and then over its useful life, I'm turning it into depreciation expense and running that through my income statement. Some terms we need to be aware of. Its book value is what the value on our accounting records. So the way to calculate it is its cost minus the accumulated depreciation, and the way to think about it is it's what that asset is on our balance sheet for. That is its book value. It does not reflect its market value. It does not reflect what I could sell it for. It is simply what it is on my accounting record, the value that is on my accounting records. Depreciation is a contra asset account. We've talked about contra accounts before. Contra accounts are accounts with funny balances. So since it's a contra asset account, we usually expect assets to have debit balances. So depreciation or accumulated depreciation, it probably really should say, is a contra asset account. So it is an asset with a credit balance. Okay, and what it does is what it represents is the costs, the portion of that asset's costs that have already been allocated to expense, how much we've already depreciated it, so to speak. The causes of depreciation are twofold. One is physical deterioration. You buy the truck, it wears out. Okay, and so that's one of the causes for depreciation. The other one is because products become obsolete. Okay, you buy the computer, and over time, that computer becomes old, doesn't function anymore, and becomes obsolete. Using straight line, and 90 to 95% of all companies use straight line depreciation. For exam purposes, you'll be responsible for straight line. There are other methods. I'm going to talk about one, but there are other methods. To calculate the straight line depreciation expense in a year, we take the cost, we subtract its residual value, and the residual value is what we expect it to be worth, what its value is going to be when it's all used up. Even a truck that we've used extensively for the last 5 to 10 years or whatever still has a little bit of value left. I mean, we're going to get maybe $3,000 for it or $5,000 when we go to trade it in. That's going to be the residual value. And then we're going to divide it by its useful life, which is the number of years we expect to have that truck and to be using that truck, that it's going to be useful. For things like trucks, it's probably usually 5 years. For buildings, it's probably 30 years. And there is some accounting judgment that goes into those numbers. So notice what we have here. We have on January 2nd, Wholesale Grocery buys a new delivery truck. The cost was $17,000. Estimated residual value of $2,000. I'm going to have to provide you with that estimated residual value. And an estimated useful life of 5 years. So notice what they did. They took the $17,000, which is the cost. They subtracted the residual value, $2,000, and they're going to use it over 5 years. So they're going to get $3,000 worth of depreciation per year. Okay, so notice what happens. Okay, every year for the 5 years, they're going to depreciate at $3,000. That's column 1. Notice what happens to accumulated depreciation. Accumulated depreciation, which is in column 3, goes up by $3,000 every year. So after year 1, the accumulated depreciation is $3,000. After 2 years, it's $6,000. And it goes all the way up to $15,000, where after the 5th year, we've depreciated it for 3 years. And notice what happens to the book value. The book value started at 17. I put it on my balance sheet at 17,000. After the first year, where I've depreciated it for $3,000, what's its book value? Its book value is 14,000. After the second year, when I've depreciated it another $3,000, what's its book value? 11,000. After the third year, we're down to book value of 8,000. And notice what happens at the end of year 5. At the end of year 5, it is fully depreciated, and we're down to its salvage value, which is 2,000. And at that point, I stop depreciating it. I will never, ever, ever, ever depreciate something below its estimated salvage value, or sometimes the term that's used is residual value. You can and you do depreciate things for fractional periods. The most common here in the accounting book is half year, using what we call the half year convention, which assumes that you've put the property in place during and it's been in use for half a year. And that means no matter when I put it in service, if I put it in service on January 2nd, even though I've put it in service on January 2nd and I've used it the entire year, how much depreciation will I take the first year? One half of that year's depreciation. Likewise, if I put the truck or what have you in service on December 1st, how much depreciation am I going to take in that particular case? A half a year. So it's just an assumption to make things easier, so I don't have to keep track of days, months, weeks, what have you. Some companies may use some method other than a half-year convention. I've seen companies use monthly, but usually a half year is the one that's most widely used. So notice what happens here. Using the half-year convention, they purchased 100 desktop computers throughout the year. Total cost was $600, and this is very common for companies to have just one, not keep track of each computer separately, but to have one entire group called computers. And so notice the total is $600,000. They're going to depreciate it by straight line. There's no residual value. So notice what they did. They took $600,000, divided it, subtracted the zero residual value, divided it by the 5 years they're going to be useful. So they have $120,000 in depreciation per year. because they're using the half-year convention, how much depreciation are they going to get? In the first year, they're going to get 60 grand. Okay. And so one quick note about half-year convention. If you worked this out, you're going to end up depreciating it over 6 calendar years because you're only going to get half the depreciation in that first year. Then you're going to depreciate it for 4 full years. So we depreciated 120 for 4 full years. So notice what happens. We have 60 grand the first year. We have 4 full years at 120 grand. Okay, that's 480 plus 60 is 540. I've got another 60 grand, and that other 60 grand is going to show up in year 6 because I'm going to get that other half year worth of depreciation. So even though it's a 5-year life, when I look at my accounting records, it's going to be depreciated over 6 years. A half year the first year, 4 full years, and then a half year the second year, or the half year in year 6. There is another method. It's called the declining balance. Sometimes you'll see the term double declining balance or 150% declining balance. Makers, which is used for tax purposes, is a declining balance method. And the normal one for short-lived assets is double declining balance. It is calculated in a slightly different way where they do not take the residual value into account at the beginning. They just watch for it as they get closer, and they multiply it by the accelerated depreciation rate. Okay, so in this case, it's double declining balance. What they're doing is what they call double declining balance. So what you would do is take, let's suppose it was a 5-year asset. We would take 100%. We're going to depreciate 100%. You always assume 100% for this, even if it's got a residual value. Divide it by 5. And 100% divided by 5 means we're going to take it by 20% per year. Since it's double declining balance, we're going to depreciate it by 40%. So let's see how this works. Okay, and notice what happens. We bought that delivery truck, 17 grand, residual value of 2, estimated useful life of 5 years. So what you do is you ignore the residual value. You take 17 grand, divide it by or multiply it by 40%, and the depreciation in year 1 is 6,800. And then notice what they do in the subsequent years. In the subsequent years, after you've depreciated at $6,800, the book value is $10,200. So you take the $10,200 and multiply it times 40%, which is the double declining rate, and your depreciation expense in year 2 is $4,080. Your accumulated depreciation now is $10,880, and the book value is down to $6,120. Then notice in year 3, you take the $6,120 at the 40%, get the $2,448 for your depreciation expense. Your accumulated depreciation goes up to $13,328. Book value falls to $3,362. And notice in year 5, you just end up plugging in $203. Why? Because the book value cannot go below the residual value. Okay, so you have to stop when you get to 2 grand, and so you end up plugging in year 5. There are times where in the later years of an asset, you'll also switch from double declining balance or a declining balance method to straight line. It is strictly a matter of accounting judgment, and can't give you a lot of great rules for that. Just saying it is not uncommon to switch to straight line in later years. That's about one other quick note. The depreciation expense under all methods is still 15 grand. So my total depreciation under the declining balance is 15 grand. Under straight line, it was 15 grand. It's just a matter of getting more of that depreciation in the early years of the asset's useful life. You do have to disclose your financial, the depreciation method you use in your notes to your financial statements. Okay. Useful lives can differ from company to company, but you do have to disclose what they are, and you have to be consistent. You can't switch from one method to another every year. Is it okay to switch from time to time from one method to the other because it makes more sense? And the answer is yes. From time to time, it becomes necessary to revise depreciation methods. You thought it was going to be useful for 5 years, and now you realize it's going to be useful for 8 years, or perhaps you thought it was going to be useful for 8 years, and now you find out it's only going to be useful for 5 years. Okay, as new information comes to light, can you change the depreciation method? The answer is yes. Okay. Um, how can we go ahead and do this? They acquired a $10,000 asset. Useful life was 5 years, no residual value. Okay. At the beginning of the 4th year, management decides the asset will last for 5 more years. So is it appropriate, or can they change the annual depreciation? And the answer is yes. So notice what they did. At the end of, oops, let me just make sure. At the beginning of the 4th year, so they've depreciated it 3 years so far. So they've already taken $6,000 of depreciation because of the $2,000 per year. So they have $4,000 left. Okay, they've now decided it's going to last another 5 years. So what do? They change the value to, in this case, their annual depreciation to $800. Okay, and so instead of depreciating it by $2,000 per year like they did for the first 3 years, they're now going to depreciate it by $800 for the remaining 5 years. That concludes what I'm going to talk about here in the first part of the lecture. I will conclude Chapter 9 in the second part. Thank you.